Good morning. This is Frank Lovaglio, and
I'm Dave Allen.
We're with Financially Speaking with SFM. We're excited about this. We're going to start coming to you monthly with market updates and ideas.
As some of you guys may have seen us on TV, we are on Fox every Sunday morning at 11 o'clock, and we've just decided to
Take it in-house,
create our own little studio in-house, and come to you more often with good topics. We're going to have a YouTube channel. We're going to be sending it over via email. It'll be on LinkedIn. There'll be a number of days, and we'll be posted on our website. So it'll be some good information, and we hope you enjoy it.
And I wanted to start off by just going over a little bit of history of the market and why it makes sense to continue to stay invested versus trying to get in and out. And so I'll go back and look at, Dave and I have been sitting in this financial advisory chair going on 40 years, 4 decades, if you can believe it.
Since 83. And,
we've seen a lot of stuff, and we've seen a lot of markets. And I'm going to go back to, I was a younger man then, no gray hair. And in 1987, the market went down over 21% in one day. So if you think about what happened then, 1987, almost 1/4 of the market was evaporated just in one day. And what happened to the market? It came back bigger and stronger in the next 5 years than ever before. Then you get to 2001, I'll skip ahead. Large buildings in New York City are getting demolished. Big jets or terrorist attacks are all over New York. 2 buildings fall down. The markets deteriorate, 2001 and 2. What's the market do? It gets devastated, down 25-30%. What happens? It comes back bigger and stronger than it did before. Then you play that forward to the biggest, besides the Great Depression in the 40s, it was the biggest economic downturn ever. You have companies like Bear Stearns, companies like Lehman Brothers. For years, Dave and I used to use the Lehman Index, which was the index that worldwide used to measure stocks and bonds, called the Lehman Index. Lehman Brothers goes broke. The story goes on and on. 2008 and 2009 was a catastrophic financial crisis where the markets went down, another 40%. What happens? They come back bigger and stronger than they did before. Then you have the most recent, which it feels like with this big inflation push now, we all forgot about it, but we didn't. COVID. We get a disease that comes in out of nowhere. People start dying from a disease, almost like the bubonic plague. Never in our history, in my lifetime, born in the early 60s, had I ever seen a disease start to kill citizens all over the world. We have COVID. Market goes down 30% quickly, and we don't know what's going on. We're all panicked, but the people that, again, stayed invested, kept a longer-term focus, were the winners. What happened after COVID? It goes into a V-shaped recovery. The market comes completely back and then goes up another 20+%. And we're all thinking we're all in good shape. What happens? Inflation. January of 2022. It's been the worst 3 quarters since 2002. The last 20 years, we haven't seen the first 9 months this catastrophic. So here we are today. And what I would tell you is we talked about 87, we talked about 2001, we talked about 2008 and 9, we talked about COVID of 2020. I have no crystal ball. There's actually a crystal ball right here. See the crystal ball? Don't have it, putting it back. But I believe that we'll be bigger and stronger than we were before. And I think those are the kind of things we need to make sure we do. We need to be long-term perspective, not short-term thinkers. And it's hard. Dave and I put our money where our mouth is. We have money in the market too. And when I see my September statement, it's not fun. But we got to look at historically, not to panic. Markets come back every time historically.
To kind of add to what you were referring to, Frank, and the beginning of time, 1987, our beginning of time, 1987, we'd been in the business for 4 years. It felt very strange for us because I think we just had
Our mom and dad was our client.
Our one client was
my sister fired me, so I had two.
Yeah, we got fired by a sister and a parent that day. But That was it. So that was just.
It wasn't as drastic as we thought.
No, it
was
really wasn't. It felt bad, but Mom and Dad were kind of upset.
Yeah.
So
and they had to feed us Thanksgiving
no, I'm
anyway.
just kidding. I don't think I had a claim then. But no, the reality is what I want to kind of reinforce is focusing on the long term and emotions. Don't focus on the next 3 months. Don't focus on the next 6 months. Focus on the long term. And let's bring back one of the things that people always say as we're heading into the recession, the market is going to go down too. Well, yeah, there is some kind of correlation, but the biggest thing I want to give you a memory of. We all remember the market high of 2008. Frank talked about it as the Great Recession. And we all can't forget it because there were many jobs lost. There was times you couldn't sell your house. You were underwater in your house. There were foreclosures. There were short sales. It was pretty dramatic. I was actually, underwater in my own house, but I held on and I was just fine. Yeah. But let's think about it. 2008, market high. Market starts going down, and it hit its low in approximately March of 2009. At that point, the market is a leading indicator. What the market said is we're coming into a recession. But guess how long that recession lasted? It was one of the longest I can remember. I remember it being almost out into 2011 and 2012 because it started with the stock market. Always the first to react because it's a leading indicator, telling something's coming. And then in 2009, it hit its low. And then what happened after 2009, the market started to rise. It had a very good year in 2009, recovering from its lows. 2010, recovering from its lows, had a good positive year. 2011 was flat to slightly down. 2012 was up. In 2013, guess when the recession started? It started when the market started its recovery. So the big point I'm trying to make here is there's not always a perfect correlation between a recession and the market. They do tie in. Sometimes the market reacts before. And also, look at yesterday or the last 2 days we've had here. Who thought that we'd have 2 almost 800-point days in a row? If you weren't in it, you missed it. So just a little bit of feedback and thought process on recession that really, it started with the stock market, then it went into commercial housing, residential housing, then went into the commercial market. It kind of flowed through like a fire. And then it was over, 2012. That's when everything caught on fire again and the world got back again. So just a little thought on recession and the stock market. Thank you for listening and joining us today on Financially Speaking with SFM. We hope to bring a whole lot more to you on an ongoing basis. Thank you for listening, and we always have the tagline, it's not what you earn, it's what you keep.